Welcome to the Deep Dive. We're digging into a whole stack of source material today, research notes, forecasts, articles, all pointing to a really pivotal week ahead for the markets.
Absolutely. It feels like a big one. We've got major economic data, key earnings reports. It's packed.
It really is. And our mission today, looking at all this material, is to kind of unpack it all and pull out the most important insights for you for this week, June 9th through the 13th, 2025.
Yeah.
We want to help you understand what's really driving things.
Because there's this real tension brewing, isn't there? The sources highlight it clearly. You've got those persistent inflation fears still hanging around.
Right, they just won't quite go away.
But then you also have this possibility that some big tech earnings could actually provide a lift, maybe counteract some of that inflation worry.
Exactly. It feels like a confrontation of ideas. And this week's data, the reports, they're going to give us some crucial clues about which way things might tilt.
Yeah, definitely near-term direction finders.
Okay, so let's start where the sources overwhelmingly agree we should start. U.S. inflation data. It seems like the biggest potential market mover this week.
It's absolutely paramount. I mean, every inflation data point right now is getting put under a microscope. And the reason is simple. It feeds directly into what the Federal Reserve might do.
And their next big meeting, the FOMC, is right around the corner, isn't it?
Right after this week, June 17th and 18th. So these reports, they're basically the last major pieces of inflation puzzle the Fed gets before making their decision.
Okay, so the key dates everyone's watching. Wednesday, June 11th for the Consumer Price Index, CPI, and then Thursday, June 12th for the Producer Price Index, PPI, both at 8:30 a.m. Eastern.
Let's zero in on CPI first. That's the big one for consumers, right? What we pay for goods and services. It's pivotal.
And the numbers to watch. For May, the consensus seems to be for headline CPI to rise 0.2% month over month.
That's right, which would put the year-over-year rate at 2.5%, a little tick up from April's 2.3%.
But the Fed really focuses on the core CPI, the one that strips out food and energy.
Exactly. They see that as a better signal of underlying inflation trends. And the consensus there is for a 0.3% month-over-month increase, bringing the year-over-year core rate to 2.9%.
So wait, even the consensus expects core inflation to tick slightly higher year over year, from 2.8% in April to 2.9%.
That's what the forecasts are showing, yes. So baseline expectation isn't exactly screaming, rapid disinflation continues smoothly.
Okay, now here's where it gets really interesting, based on some of the other source material we looked at. This could be that aha moment, or maybe an uh-oh moment. Several notes pointed to recent PMI surveys.
Ah, yes, the Purchasing Managers Indexes.
And those surveys, for May, they hinted that U.S. companies reported the largest increase in prices they charged since September 2022.
That's the stat that jumped out. And manufacturing output prices specifically, fastest rise in 2.5 years.
So hold on. The official CPI forecast is relatively tame, like 0.2% or 0.3% monthly increases. But these company surveys show the biggest price hikes in almost 2 years. That seems like a disconnect. What's driving that in the PMIs, according to the sources?
Well, the sources attribute it pretty directly to rising costs from their suppliers, which companies are then, passing along.
And why are supplier costs going up?
The finger often points back to things like tariffs and maybe related supply shortages or disruptions caused by those tariffs.
Okay. So tariffs push up input costs, manufacturers pass it on, and that's showing up in the PMI surveys before potentially showing up in the official CPI.
That's the implication.
Yeah.
It creates this very real possibility. Some sources call it a strong possibility of an upside surprise in the May CPI number, particularly core CPI.
So if CPI comes in hotter than that already slightly elevated forecast?
It directly challenges the market narrative, the hope that inflation is just steadily, smoothly cooling down towards that 2% Fed target. It suggests maybe there are still bumps in the road.
Okay, that definitely puts Wednesday's CPI number front and center. Then Thursday we get PPI, producer prices.
Right. What producers pay for their inputs, sometimes seen as a leading indicator for CPI down the line, though the link isn't always perfect.
And the forecast there. Consensus is looking for a rebound after April was kind of soft, right?
Yeah, April saw negative prints. For May, headline PPI consensus is plus 0.2% month over month, bouncing back from minus 0.5%. Core PPI is expected at plus 0.3%, rebounding from meta 0.4%.
So if CPI comes in hot on Wednesday, and then PPI on Thursday shows producer costs are also bouncing back strongly.
That would feel like a double whammy, wouldn't it? It would definitely reinforce concerns raised by a hot CPI. If both surprise to the upside, it builds a much stronger case that inflation is proving stickier, maybe even reaccelerating a bit. Makes the Fed's job look harder.
Okay, let's connect the dots for you listening. If this inflation data, especially core CPI and maybe PPI too, comes in hotter than these consensus numbers we've talked about, what's the likely market reaction?
Well, it pushes expectations firmly towards the Fed needing to keep interest rates higher for longer. Hopes for multiple rate cuts later this year would probably, diminish significantly.
Maybe even whispers of another hike, though the sources say that's an outside risk.
It's an outside risk, but a hotter than expected print would certainly make people nervous about it. The main impact is pushing out rate cut expectations.
And that higher for longer view directly hits asset prices, right? Stocks, especially tech and growth stocks, tend not to like higher rates. Bonds, too.
Exactly. Higher rates mean lower stock valuations, generally speaking. And for bonds, higher expected rates mean lower prices, which means higher yields.
Okay, but what if the opposite happens? What if the data comes in cool, meets or beats consensus to the downside?
Well, that's the other side of the coin. Cooler data would strongly support the narrative that inflation is cooling, validating hopes for rate cuts later in the year. That's generally bullish for both stocks and bonds. So you see how pivotal these two reports are.
Huge swing factor for the week. But it's not only about CPI and PPI, is it? There are a couple of other reports the sources flagged.
That's right. Also on Thursday, same day as PPI, we get the weekly initial jobless claims. Just a regular check on the labor market's health.
Which the Fed watches because wages link to inflation. Previous was 247,000 claims. Consensus is for a bit lower, 239,000.
Right. So a number around consensus probably doesn't move the needle much. But if you saw a big unexpected jump in claims, say well above 250K.
That would signal the job market is weakening more rapidly.
Potentially, yes. Which theoretically could ease some worries about wage pressures for the Fed. But it also brings in worries about economic growth, recession risk. So it's not automatically good news.
A bit of a mixed signal depending on how big the jump is.
Exactly. And then Friday, June 13th, we get the first look at the University of Michigan consumer sentiment for June. Previous was 52.2. Consensus expects a slight improvement to 53.5.
But the really interesting part here, according to the sources, isn't just the headline sentiment number. It's the inflation expectations piece within that survey.
Yes, precisely. The Fed watches this really closely because expectations can become, well, self-fulfilling. If everyone expects prices to keep rising fast, they might act in ways that make it happen.
Like demanding higher wages, or companies feeling okay raising prices.
Exactly. So what you don't want to see is a situation where overall sentiment is weak. People feel bad about the economy, but their inflation expectations stay high or even go up. That starts to look like stagflation fears, slow growth, high inflation. Very tricky for policymakers.
And quickly, the sources also mentioned keeping an eye on international data. China, UK, Eurozone.
Yeah, just for background context, things like Chinese inflation or trade, UK jobs and GDP, Eurozone industrial production, they give clues about global growth, supply chains. For instance, some sources tied weak Eurozone exports recently to those same tariff issues we talked about potentially hitting U.S. prices. It's all interconnected.
Right. Global factors can ripple back. Yeah. Okay, let's shift gears from the big macro picture to the micro individual companies. Because while inflation's the big cloud overhead, earnings are critical too, especially from the tech sector given its market weight.
Definitely. And the spotlight this week, based on your sources, falls squarely on two big tech names reporting after the close. Oracle on Wednesday and Adobe on Thursday.
Let's dig into Oracle first. Fiscal Q4. Expected revenue around $15.5 billion, decent growth, EPS around $1.64, more modest growth there.
The absolute key theme for Oracle coming through in all the notes is their cloud performance, specifically Oracle Cloud Infrastructure, OCI. Is that growth really robust?
What are analysts looking for there?
They're projecting that specific segment, infrastructure, cloud services, and license support, to grow around 19.8% year over year. That's a big number, close to $6.7 billion. It's the main way they measure progress against AWS, Azure, Google Cloud.
And what about those big partnerships they announced with Google and Microsoft? Are those actually helping them win business?
That's another critical question. Updates on those are essential. Are they translating into real multi-cloud deals? Is Oracle expanding its reach beyond its traditional database comfort zone? Investors need to see proof points.
And then there's AI. Always AI. They've got the NVIDIA AI Enterprise on OCI.
Hugely important. How's adoption going? But crucially, remember last quarter, sources said AI demand actually hit capacity constraints for Oracle.
Oh, right. I remember that. They couldn't fulfill all the demand.
That was the report. So did they fix that in Q4? Can they meet the demand now? Commentary on that will be vital. Because if you have strong AI demand but can't deliver, that's not great.
Plus, they missed expectations last quarter overall, didn't they? So execution quality is under scrutiny.
It really is. The stakes feel pretty high for Oracle. If they deliver a strong report, good OCI growth, maybe resolving those capacity issues, positive AI commentary, it could signal a turnaround. The stock's actually lagged a bit, down about 10% over 6 months.
But if they miss again, or guidance is cautious, especially if it hints OCI is slowing, or capacity is still an issue.
Could be a significant negative reaction, yeah. Especially if the broader market is already a bit nervous about earnings growth.
Okay, then Thursday after the bell, Adobe reports its fiscal Q2. Expectations are adjusted EPS around $4.97, revenue near $5.8 billion. Solid numbers expected year over year.
But for Adobe, the focus is laser sharp, isn't it? It's all about AI monetization.
Right. They've put generative AI features into Creative Cloud, Experience Cloud. But are people paying up for it? Is it driving new revenue?
That's the billion-dollar question. Sources note that, so far, the reports suggest AI revenue growth has kind of lagged what the market hoped for.
So are customers using the features but not upgrading yet? Or is the value proposition not clear enough?
We need clarity on that. Are the AI features translating into actual dollars? Investors will be looking for specific metrics, commentary, anything that shows tangible progress on AI monetization, plus the usual stuff like subscription growth and guidance.
And there's that fascinating historical tidbit about Adobe's stock reaction to earnings.
It's quite something, isn't it? One note highlighted that over the last 5 years, the stock price dropped the day after earnings 70% of the time.
70%. And the median drop was significant, like 7.4%.
Exactly. So there's this historical pattern of negative reaction, whether it's expectations being too high, cautious guidance, or just sell the news. It creates a high bar.
So the big question for Adobe is, can clear evidence of accelerating AI revenue finally break that negative pattern?
That's the hope for bulls. If they can show AI is really starting to pay off, it wouldn't just be good for Adobe. It could lift sentiment for other software companies also trying to prove their AI strategies are working financially.
But if AI monetization still looks weak, or guidance is cautious,
It could feed into those broader concerns about whether generative AI can really drive near-term profits across the sector, potentially pressuring valuations for software stocks.
Okay, so let's try and weave this all together. We've got the big inflation picture, these key tech earnings. It really sets up a confrontation of ideas in the market this week.
It really does. You can frame it as two opposing scenarios, kind of battling for dominance.
What's the biggest risk scenario?
The biggest risk, clearly, is inflation coming in hot. CPI, PPI, especially the core numbers, may be confirming those worrying signals from the PMI surveys.
And if that happens?
Market reaction is likely swift. Hopes for Fed rate cuts get dashed, pushed way out. Focus shifts to higher for longer. Stocks likely sell off, particularly tech. Bond yields would probably rise sharply. The dollar might strengthen. It basically says inflation isn't beaten yet. The Fed might have to stay tight, maybe too tight, risking a recession. That's the pessimistic view.
Okay, but then the flip side, the key opportunity scenario.
That happens if inflation data does show clear cooling, meeting, or undershooting forecasts. And importantly, if Oracle and Adobe deliver strong results, Oracle showing OCI strength, Adobe proving AI monetization is real and accelerating.
What does that world look like?
Much brighter. Fed fears ease significantly. The path for rate cuts later this year looks clearer. You'd expect a risk-on rally, probably led by tech. Bond yields would likely fall, the dollar might weaken. It supports that soft landing narrative, inflation comes down without killing the economy, and tech innovation drives growth. That's the optimistic counterpoint.
And obviously, reality could be somewhere in the messy middle, right? Mixed signals.
Absolutely. Hot CPI, but great tech earnings, or cool CPI, but Oracle stumbles. That could lead to choppy, uncertain trading as the market tries to figure out what matters more.
So, for you navigating this week, what's the takeaway?
Agility seems key. And focus. You really need to watch these specific data points, core CPI, PPI, and these specific earnings reports, Oracle, Adobe, very closely. How they land will heavily shape the market's mood and narrative going into that Fed meeting next week. It's about which story gains more traction.
Yeah, this deep dive really underscores how much is riding on just these next few days.
It really does. From those potential inflation surprises hinted at in the PMI data to whether giants like Oracle can overcome recent issues, and if Adobe can finally show the market the money from its AI investments, the stakes feel quite high, both macro and micro.
Here's something to think about as the data comes in. How much protection can strong company results and exciting tech stories really offer if that bigger force, inflation, forces the Fed's hand towards keeping rates high? Where does that balance point lie?
That's the central tension, isn't it? That confrontation of forces we talked about. Definitely something to mull over this week.
And to get the fastest updates on how all this critical data and these earnings are actually impacting the market narrative in real time.
Make sure you're subscribed. We'll be tracking it closely.
Don't miss out. Subscribe to the Deep Dive.